Best ever listeners, welcome back to the Best Ever CRE show. We have another Beyond Multifamily episode for you today. Man, I'm botching my speaking today, so good luck. Good luck to everybody listening today. I can't say substitute. I can't even say Beyond Multifamily. What's
Luckily,
up,
you did
Ash?
a lot better in today's interview. You did great. Hey, Amanda, interesting guy today, Stephen Weir, that we interviewed, a gentleman out of Chicago that is doing some neat things in self-storage. And if you would dive into this whole financing thing that he's working on.
Yeah, it was quite interesting. I mean, he's still hanging in there with self-storage and he's making it work in different angles. And one of those is how they're financing them. So he walked through some of the things he's doing with his seller financing notes that I took something from. I think investors out there, if you have seller financing notes, you may be able to work this into your strategy as well. So I thought that was pretty interesting.
And wants to tie in data centers. This is interesting.
We kind of went all over the place on this one. So I think that'll be awesome. A couple things. If you're a self-storage investor and you want to get out of self-storage, make sure you're coming to the Best Ever Conference, because then you can talk to us. You can talk to, well, maybe not multifamily investors, Ash. I know you hate on them a little bit, but
what are you going to learn from them? What can you learn from them?
We're all going to be at the Best Ever Conference, though. So if you haven't already gotten your ticket, you can go to besteverconference.com. Use podcast 10, all uppercase, to get 10% off. And come chat with us, too. Come apply to be on the show. If you do investing that is not apartment buildings, we want to hear about it. We want to hear your highs, your lows. We want to chat with you.
Let's go.
Let's do it. Stephen Ware, welcome to the Best Ever CRE show. How's it going?
It's going good. Thanks so much for having me.
Hey, we're excited to chat with you. And before we get too far into it, can you give the Best Ever listeners a bit about your background and what you're focused on?
Absolutely. So my name is Stephen Ware. I am the Chief Marketing Officer of SSSE based out of Chicago, Illinois. We're a self-storage investing firm that operates nationwide. We acquire, develop, and syndicate self-storage. There's pretty much nothing in self-storage that we don't do. Over the past 7 years, we've done over $225 million in self-storage transactions, and we've operated in 28 of the 50 states.
This sounds so boring. Self-storage. Come on, man. Any more excitement in your future? Are you going to pivot? What are you going to do? Everybody's doing self-storage.
Well, see, we were doing it before it was cool. That's what our opinion.
How long have you been doing it for?
So we've been doing it for 7 years. So we actually got started in residential real estate, then did the typical life cycle of upgrading to, commercial multifamily, start dabbling in some other, real estate asset classes, but then became tired landlords pretty quickly. So wanted to avoid those tenants, toilets, trash. And so we accepted the gospel of self-storage, and we've been living it ever since.
You guys rode a hell of a wave, because when multifamily started going in the shitter, self-storage was where a lot of people pivoted to, just like yourselves, and cap rates really compressed. So any assets you held probably went through the roof, and now it's kind of a different story, isn't it?
It's a different flavor of the same dish is what we think for self-storage.
Sounds like a marketing guy, Amanda. Sounds just like a marketing
Hey, you're
guy.
good, Stephen. I see why you're paid the big bucks.
Yeah. So, we think it's still very good in self-storage. So you're absolutely right. During COVID especially, kind of the cracks in residential or habituated real estate kind of came out. Self-storage thrived. In some markets, self-storage experienced 7% month-over-month rental rate increases. There's been a bit of a pullback since then, because that's unsustainable. That's wild. But
geographically, where do you invest?
So we typically like to go anywhere there's going to be population growth as well as high income. So mostly common sense sort of stuff. For us, we're seeing most of our self-storage facilities in the Midwest. We're seeing it in the Southeast, the Northeast. We're not doing a ton on the West Coast. We're not doing a ton in the Southwest. Partially because why we've been successful and why everyone getting into self-storage, experiencing these cap rate compressions, is because they're looking in primary markets. We typically operate in secondary and tertiary markets, which especially after COVID has been a great choice. There's been a couple moves that have made us feel very, very smart. One being in self-storage before COVID, Two, already being in the secondary and tertiary markets, because a lot of the criticisms that self-storage can get are based around saturation. There's too many people either looking to get into self-storage, or there's too many self-storage facilities in an area.
All right, hang on, Stephen, because I like where you're going. So you made a hell of the right decision. You got into self-storage pre-COVID. Awesome. I think all of us that own real estate pre-COVID are like, hell yeah, look how smart we are. We're the best. All right, but then you did second and tertiary markets, which it sounds like has been really, really good for you. But tell me where I'm wrong here. I thought the downside of the secondary and tertiary markets and self-storage is somebody can build right across the street from you. There's nothing stopping that. So tell me, how am I wrong here? Fix this.
So you're not wrong. That is always a fear. So whenever we find out that a town has a moratorium on self-storage, we're clicking our heels. We're thrilled about that. So we're looking for those sorts of things. And to be honest, not to be a savage, we do like to try and close the door behind us as well. So if we get something approved in a town, we go, we're going to meet your town's needs for self-storage. We think that you should discourage anyone else from making a bad decision, because we see that as well. Like, for instance, we bought a self-storage facility in a smaller town. I mean, secondary market, but it's part of the Detroit Flint MSA. And there's only 2 self-storage facilities in this town. And it's a town of about 40,000 people. But one of the self-storage facilities, they built brand new, and they're trying to lease it up. And they will pay you to rent a unit at their self-storage facility. We bought an existing self-storage facility that already was at 75, 80% occupancy. So for us, we already have this competitive advantage where we're not trying to get people in, we're just trying to retain them. And self-storage in itself has a sticky factor where once you've moved in your couch, your dressers, your boxes, you don't really want to be moving out. Even if somebody a mile down the way is saying, hey, I've got a self-storage facility that's brighter, better, newer, come to us, we'll give you basically for free. I still have to move all of my stuff out of my unit. So to your point, Amanda, like, as long as we're not in a lease-up situation, we're okay with secondary and tertiary markets. If we're building ground up, then we are looking for markets that are closer to that primary market. We're probably not developing in a tertiary market unless it's an expansion of an existing facility.
And did we hear you say that you actually go to the local municipality and say, hey, look, you don't need any more self-storage. Let's just make a rule that there can't be any more?
We suggested, I mean, if we're going to have to go through the rigmarole of talking with zoning departments and getting all these approvals and permits, we might as well have some conversations about other things that are related to the subject. So
Does it work?
Sometimes, yeah. Sometimes they go, yeah, you're right. We don't think there should be any more. So for instance, in that Michigan town that I just mentioned, yes, there is the facility that was built a couple years ago, but still struggling to lease up. There was a piece of land across the street from that facility that was getting put forth as you should develop self-storage here. And the city said, no, we don't think so. Yes, it fits the zoning, but we won't approve it.
Amanda's a good Southern girl. She's a little taken back by this. Bro, I'm from Jersey. Like, I'm the guy not paying off, but donating to politicians to get what we want. So, yeah, why not, man?
Well, we're
In
looking from
mobile
a
home
data
parks, we don't have to
perspective.
worry about this, okay? There's zoning. We can't even build anymore. So this is totally opposite of where I'm used to being.
So whenever we do a development, we're getting a feasibility study done. And in that feasibility study, they're going to say, here's what the self-storage square footage that we think this market can support. Here is what the shortfall is. So if you want to develop in this market, there's a shortfall of 120,000 net rentable square feet. We will use that information to say, hey, we think that this market really needs this. This is a fundamental need of your village, your town, your city. We want to provide that for you guys. We're going to be providing everything that you need with this. Based on this third-party report, don't believe us. Trust the experts. And what they do with that information?
That's with acquisition, right? How about in the Flint, Michigan case? So you had a brand new facility nearby, but you bought existing. Tell me about Flint, Michigan, because all I know is there's a water situation there. It's not pretty. I have this terrible thought in my head. It's like one of the worst markets in the country. That must not be true. Paint the picture for us of this facility.
Well, I don't live in Flint, so I can't speak for certain, but I have heard that they've done a lot with the water since then. But that is my memory as well. Thankfully, this facility is not in Flint, Michigan, as well as the fact that we're not having any sort of plumbing at this facility for people to be drinking out of water fountains. Any location that has people needs self-storage. And the reality is that Flint, as an MSA, has hundreds of thousands of people that live there. And there's some great areas around it, some great towns, including Flint, Michigan. I'm not here to, poo-poo on Flint, Michigan, but there's a lot of lakes, for instance, around Flint, Michigan. So there's a lot of recreation demand for where do I store my boat, my RV? And we're here to do that. And to your point, even during the Flint, Michigan water crisis, I imagine self-storage was particularly necessary because of the fact that self-storage is an industry of transition. So whenever people need to move, they need self-storage, whether it be coming into a market, which we prefer, or moving out of a market.
All right. So even when they're leaving a market, if the population is going down, you still see some short-term advantage to going in. And then what is your exit play in a declining population area?
Well, as long as it's not a risk of declining to 0%, we're not that concerned. And plus, we're not choosing markets where it's so small where, if you lose a couple thousand people, we're donezo. Typically, our deals, our syndications are 5-year syndications just to mirror the sort of debt that we're typically putting on them. So 5-year, 25-year amortization is the typical commercial debt that we're placing on these self-storage facilities. So we're looking at these as snapshots of 5 years. Now, it's not necessarily a game of hot potato where we're just trying to hand off a self-storage facility that's destined for failure. That's not our game plan. We always want to leave meat on the bone and have it so that someone else is going to have great success with what we've started. Just like we look for self-storage facilities where the owner has started something great and we can go ahead and take it to the next level. But with that transition, we see this goes in kind of a cyclical nature. I was seeing an article the other day that the top 9 industrial cities in the country that have experienced some of the greatest population flight over the past 30 years are actually some of the fastest growing markets now as people come back in. And Detroit is actually one of those markets where in this quote unquote housing crisis that we have, where the affordability index is through the roof, going to these markets that were once, these populous, great areas to live, they're remaking them into be great ones once again.
Stephen, Amanda and I recently interviewed somebody in the self-storage space, and they've done some innovative things like on certain days of the week, they bring someone in to wrap boats, or you can have your car washed while it's in storage, or they do package delivery inside your unit. Are you doing anything innovative, or are you running it just traditional self-storage business?
So it's a double-edged sword because on the one end, there's a ton of different ways to introduce ancillary income streams to self-storage. Things like having it as an office center where you can do shipping, Zoom meetings, conferences, PO boxes, things like that. You can go ahead and offer some ancillary services that complement the kind of specialty storage that you're doing between, RV and boat storage. You can go ahead and have the boats wrapped. You can have the RVs be able to refill their water, refill their propane there. You could do the car wash element. I know that some, partner up with RV parks, laundromats, things like that. We find it to be a double-edged sword because the more layers that you introduce, the more management costs that goes with it. Now, the beauty of self-storage isn't that it's easy, but it is simple in comparison to some other real estate asset classes. So we always want to see how can we get the largest ROI, and that involves how can we keep our management costs low. So to your point about boat wrapping, the self-storage facility in the Flint, Michigan MSA, it's right near a bunch of lakes. We get a ton of boats that are parked there. We bought it partially because it's connected to a hardware store. That hardware store will let them wrap the boats. They get to keep all of the income from wrapping the boats. But because they wrap boats, because people are bringing their boats to be wrapped by them, having the storage right next door to where they're getting it wrapped is a symbiotic relationship that we like. So it costs us $0 additional dollars, but we get to benefit from their actions. So we always like to look at it that way. Sometimes we'll bring in third parties where they'll just operate these ancillary income streams and we get a revenue share with them just so we don't have to have employees that may be seasonal or not required. But it is something that we're interested in. But there is one thing about an ancillary income stream for self-storage that I am very excited about. And it actually has to do with a symbiotic relationship with data centers.
Keep going. You can't set yourself up and stop, man. Just let it go.
Wanted to build the suspense here. So one of the greatest resources that self-storage has that I believe is being underutilized is roof space. So there's been a pendulum swing in the style of self-storage that's being developed. It used to be that the REITs liked multi-story, temperature-controlled self-storage. Smaller plot of land needed, still get to maximize that land by going vertical. That's what REITs like to see. But tenants don't actually necessarily like to use an elevator. If I have to move a couch, we don't want it to be like the Friends episode of pivot, pivot, pivot. So they like to drive up to their units to be able to load and unload. So when we build self-storage facilities, we often have a drive-through lane through the middle of a multi-story self-storage facility. So there are these premium units where you do have the same benefit of a drive-up single-story self-storage facility with that premium product of a temperature-controlled interior access self-storage facility. But because of the preference of tenants now to have the drive-up experience, we're seeing more REITs actually move towards either a hybrid model where they have a multi-story building plus some single-story buildings, or they're just building all single-story buildings. Now, when you have an all single-story self-storage facility and it's 80,000 plus square feet, that's 80,000 plus square feet of roof. We have a power crisis in this country. Where are we going to be generating all of the energy for these data centers? Now, the zoning for data centers, as well as the land availability for data centers, is similar to what you need for self-storage. We typically want at least 4 acres of land if we're doing a single-story drive-up, non-temperature controlled self-storage facility. Data centers need equally large amounts of acreage. What we believe there's an opportunity in is using solar panels on the roofs of the self-storage facility. So that the self-storage facility, yes, it is a storage facility, but first and foremost, it's a power generating property. So you use all of your roof space, regardless of the energy needs of the self-storage facility, and you use some of the square footage of the actual buildings for battery storage. So you're able to operate as a mini grid for nearby data centers. And then it just happens to be a bonus that the space underneath the solar panels is also money generating.
Stephen, this is fascinating. Are you already doing this, or is it sort of something people are considering doing right now?
So we're already rolling out solar panels at most of our properties, especially if it's a new development. Solar is on the menu, especially since a lot of the states that we're building in still have some forms of incentives surrounding solar, especially when reducing property tax, and property taxes tend to be one of the large expenses for self-storage in a lot of states.
I'm a little surprised to hear you say this, actually, because I thought a lot of the solar benefits have been cut, so people are kind of pulling back a little bit. I thought you were truly going to say on the roof, you're basically expanding it by another couple stories and building a data center on top. Have you looked at doing something like that?
So we don't want to have the building costs as well as management, operations, all of that of a data center. But if we can situate our self-storage facilities near a data center and be a part of their energy picture, that is an example of one of those symbiotic relationships that we're all about, where you can do the front of the metering, provide it to a self-storage facility. Local utilities love it. You're effectively a microgrid. And I think there's probably a world as efficiency continues to improve for solar panels that we might be able to have it so that self-storage facilities with the footprint that they have are enough of an energy producing entity for some sizes of data centers.
So in the Midwest, the average ROI for solar is 6 to 10 years. That's just to break even. Now, when you add batteries into the mix, average lifespan of a battery, the typical battery, not the newer lithium or Tesla type batteries, 3 to 4 years. And when you say feed it to the data center, you're feeding it back into the grid, not directly to the data center. Is that correct?
In most cases, yes, it's direct to the grid. And this is still in its infancy, but you're absolutely right that It does have a need for updating the infrastructure. We're hoping that as things continue to improve, the lifespan of things will improve. But it doesn't just limit to solar. We've also seen a rise in self-storage facilities that are using geothermal to produce their energy for their lights, cameras, etc.
How does geothermal produce energy?
So geothermal, I believe it's almost a steam engine that's effectively taking place where you bore a very deep hole and then it's piping, I believe, water through piping into the hole. It heats up from the Earth's heat and then it's able to produce steam and then energy from there. But I'm a storage man. I just know that it does produce energy.
Yeah, geothermal relies on the principle that the ground is always at a constant temperature, right? And I forgot what it is. Let's say it's 60 degrees. So in the summer, you can get your cooling. In the winter, it produces some level of heat, more so than what's outside. But steam would take added infrastructure. Okay, so I get that. This is an ambitious plan. Interesting. But let's go back to the fundamentals of self-storage. Go, Amanda, you were going to say something.
Along those same lines, Ash, I'm just wondering, all right, so this all sounds great. Maybe we get into data centers. Maybe we can do the solar. It sounds like we're trying to make self-storage produce revenue and look great. What about self-storage itself? Like Ash was getting at, what are you doing in that space right now? And is it viable?
Yeah, self-storage is incredibly viable. What we're seeing as the greatest avenue for return on investment within self-storage today is the creative financing. It's the structure of the purchase that is actually producing an oversized return rather than the self-storage itself. So one of our favorite things to do beyond the typical seller financing structure you may hear of, oh, you got a great low interest rate, low dollars out of pocket, so your cash on cash return's fantastic. Oh, you got a long term, wonderful. Is we love doing a substitution of collateral. So we'll go ahead and create a banking system out of our acquisitions for self-storage. Because with self-storage being a commercial real estate asset, we love the ability that every dollar that we're able to increase in the net operating income, it's 10xing in terms of the dollars that are being added to the value. So if we're then able to go ahead and refinance out our wonderful seller financing, we can then place that on another self-storage facility. And we're creating this self-perpetuating banking machine through our acquisitions and through our value add process with self-storage.
Let's walk through an example.
Okay. So we have a facility right now where it's a $3 million purchase and it's only 5% down. So $150,000 down, the remaining $2.85 million is at a 4.5% interest rate. It's interest only, and it's got a 7-year term on it. Now, this self-storage facility is ran on paper, which is a good sign. So ran on paper means that we have some pretty easy value add to introduce where people can go ahead and pay online using credit card or e-check. We can have it so that people are able to rent their own units just by introducing a website, having this management system, and then introducing some conveniences like security cameras, lighting, automatic gate, etc. Just by doing those things, we're going to be able to refinance out this self-storage facility before the end of the 7-year term. Now, the way that our mortgage and note is structured, it allows for a substitution of collateral. So we're required to go ahead and have a third-party appraiser appraise whatever asset we want to be placing this debt on. So we've got this $2.85 million debt at 4.5% interest for 7 years. And let's say it takes us 2 years to do the value add to the point where we're able to refinance out the debt so that we're able to go ahead and get all of our money and move it on to something else. When we move it on to something else, one of the benefits it allows is the seller wants effectively an annuity. One of the concerns that we always get is, okay, Steven, you're telling me that 7 years of 4.5% interest payments, I'm going to be netting over, $1 million more as long as you hold on to this property for 7 years. But what if you sell this early? Then I'm not making as much as you're putting forth as the total amount received. With a substitution of collateral, we're effectively guaranteeing that they're going to be continuing to receive those payments because we're able to go ahead and move the debt to a new cash flowing asset that with the third party appraisal, it has to be at least, if not more, than the debt that we're putting on it. Now, we're able to find self-storage facilities, because that's all we're buying, self-storage facilities at discounts to market value. So in theory, we have an opportunity to be getting into new self-storage facilities with $0 out of pocket or zero additional dollars out of pocket besides the initial down payment on the first facility, as long as we're able to find self-storage facilities that are appraising greater than what we're putting them under contract for. And that amount is greater than the debt that we want to be placing on it from the previous seller finance deal.
We've heard other people come on the show and talk to us about that. It sounds like a really smart idea as far as keeping debt moving at really low interest rates. What happens when you buy the second property? It takes longer than you expect to add the value. And here you are 5 years in and you're breaking even, but you owe back your $2.85 million. What do you do?
Well, day one, it has to appraise for more than the $2.85 million. So in theory, the protection that's taking place is that before any sort of value add, it already is enough to collateralize the debt. Now, we know that things could happen in the market, which would result in the value of the facility potentially fluctuating. But as long as it's worth the amount that we think it is day one, based on third-party agreement, and we have a low interest rate, and we're not going to be changing the debt location the last year of the financing just because then we're going to have to refinance pretty quickly. As long as all those boxes are checked, we feel fairly confident because of the value add opportunities taking place that even with a market fluctuation, that the value add that we're able to do would at least return the asset to where it was at. Otherwise, if we're talking about worst case scenario, yes, we would have to be coming out of pocket during the refinance of that seller finance product in order to make them whole.
Talk to me about how you explain this to the seller. So for this $2.8 million note you have, how did the conversation go when you were substituting the collateral, if I can speak, whatever that word is, substituting the collateral? How did the conversation go with this note holder?
So there's two ways that we present a seller finance offer that may differ from other people. The first one is that we don't focus on interest rate. We focus on dollars received per month, because the reality is that is the experience that they're looking for. I want to be receiving X amount of dollars. They're not sitting there being like, ooh-wee, I look at my bank account and it's 1% more. Like they know that it's $100,000 more, that sort of thing. So we want to shift the focus away from interest rate to what are you receiving every single month? Because that's a more practical term that they're looking for. And sometimes they get bogged down with the fact of, I went to go ahead and refinance my house the other day, and they gave me a 6% interest rate, and you're asking for a 4.5% interest rate. That doesn't jive well with me. The reality is that I am offering you a price for your asset that is removing the context of market rates. So that lower interest rate is what's allowing me to offer you the price that you're interested in. If you want to be receiving a market rate, you're going to be getting a market value. I can pay more than market value if I'm removed from the context of the banking terms out there. The second thing that we do is we shift the focus away from what is the purchase price to what is the total amount that's being received. So with all those monthly payments, plus the overall purchase price, plus the down payment over this term, this is the total amount that you're going to receive. Now, if they bring it up to me saying, hey, Stephen, you're buying this for $3 million, but if you pay every single month for 7 years at this interest rate, it comes out to be $4 million or $4.5 million. I really like the $4 million, $4.5 million. I'm not as thrilled about $3 million. That is the magic words where I go, okay, so it sounds like you don't want us to be paying off this debt early. And they go, no, I really want to receive that mailbox money every single month. It's like, it sounds like you almost want an annuity where you know that you're having this guaranteed income, a fixed amount over a fixed amount of time. They go, yeah, that'd be great. I mean, I'm selling off this self-storage facility to retire. So you're speaking retirement language right now. That's when we introduce the substitution of collateral, where we go, you already know that self-storage is a great asset. You're selling it. You know that it's treated you well. You know that this self-storage facility is worth what we're paying for it. Because if you don't agree that it's worth the amount that I'm paying for it, we need to be renegotiating how much I'm paying for it. As long as I am buying another self-storage facility and it's worth more than the debt that's there, you're getting the same sort of peace of mind with me purchasing a self-storage facility.
Is this conversation happening before, like while you're going under contract and initially negotiating, or after when you're looking at substituting the collateral?
Before. It needs to be written in, carved in stone, because that certainly is a time that you could have the conversation of, hey, Mr. Seller, we found another facility. We've done enough value add here. We got a great offer on it. We're going to sell it off or we're going to refinance. And they go, but I wanted more time of receiving interest payments. You go, well, if you want to switch over to this new facility, we can do that. We don't like to be under the gun. So we like to dot our I's, cross our T's before, and then we can go ahead and move along.
How many of these do you have?
Of the substitution collaterals?
Yeah.
So currently right now active, because we own 14 facilities right now of existing facilities, bunch of developments going on, and certainly have sold a bunch as well. Right now we have 2, but in the $47 million worth of self-storage that we have under contract right now, we have 4 that are going to be substitution of collateral.
I'm still going back to self-storage in general. So we also interviewed somebody who talked about when he's buying a self-storage facility, the highest paying tenants or clients are your existing clients. Everyone beyond that gets a lower rate, gets a discount, gets a few months free. So it begs the question, why invest in what's essentially a declining asset?
Well, I disagree with a couple things in that sentence. The first one being of your most valuable tenants are your existing tenants. I'll give that credence in the fact that the sticky factor of having existing occupancy is wonderful. Having money come in the door, that's what's producing the multiple. What I do not agree with is that getting new tenants requires this drastic discount and that it's some sort of exponential process where every subsequent tenant is also at a discount, resulting in this declining asset. As we've seen over the past 30 years, self-storage has been the number one performing real estate asset class out of the asset classes included in REIT terminology. It's beat out every single one. It's beat out the S&P 500. The S&P 500, if you invested $100,000 in 1994, it would have averaged an annual return of 10.4%. If you had invested $100,000 in 1994 into self-storage, it averaged an annual return of 18.8%. With that compounding each year, you're looking at a difference of like $1.5 million for the S&P 500 in 2021 dollars versus, I've got a note here, $10.5 million.
You're writing a marketing brochure right now.
I live and breathe this, Ash. I'm self-storage to my core. So I disagree with it being a declining asset class. And I do think that there's actually an opportunity with new tenants because it depends what sort of self-storage you're doing. If you're building a new self-storage facility, yes, in the lease-up process, especially in a competitive market, it is a cost to get new tenants between your marketing, between any sort of promotions, discounts, etc. But if you have an existing self-storage facility, often our value add is converting existing tenants into higher paying tenants. And that's coming in 2 different ways. The first one is raising their rent to market for them existing there, or getting them out of the facility to allow for a new tenant to come in at a market rate.
Stephen, one of the things we've been hearing from other self-storage investors is that market rents in self-storage have been going down over the past year, 2 years. And that's why your existing tenants are kind of the best ones because they're at the highest rate, but the newer tenants are coming in at lower market rates. Are you not seeing the same thing?
So that goes back to, I think, earlier in the podcast here. During COVID, primary markets were experiencing insane rental rate growth. Some markets, 7% month over month. So we're talking about over a 2-3 year period, greater than 100%, 200% increase in rental rates. There's been a pullback from them. So if you're buying a self-storage facility based on its current rates, and those rates were subject to the insane rental rate increases during that period, then yes, you're going to be in trouble because you're going, oh, I thought I was going to be getting $25 per square foot, and now I'm only getting $22 per square foot. That's a problem. We're not experiencing that, partially because we rarely buy in primary markets. We're buying in secondary and tertiary markets, and we're also comparing to all of the competitors. So we find that surprisingly few acquisition firms out there are actually doing a comprehensive approach to purchasing a self-storage facility when it comes to a market analysis. We view it as kind of a 3-tier approach. You have the subject facility, but that's kind of isolated. That's just the experience of this facility. It's subject to the management style, so it could either be performing better or worse, depending on what sort of management's taking place. A lot of people think they can buy a facility that's currently being managed by an on-site manager and then switch it to remote management, and they're going to be able to experience the same sort of returns that the on-site management system was generating. It's a completely different experience to the tenant, so you're also going to have a different experience in terms of your return on investment. Now, when we also look at a market, we're not just looking at the subject facility's performance, but we're also looking at what are the competitors doing. We're secret shopping every single self-storage facility. I'm finding out what their occupancy is. I'm finding out what their rental rates are, which units are performing better than others. And then I'm comparing that to my subject facility's performance. The easiest metric that people are using is the third one. The third one is the supply index number. Supply index number is kind of the benchmark for self-storage if you were to boil it down to a single metric. And that is, what is the supply of self-storage in square footage for every man, woman, and child in a market? There's a publication that comes out every single year that's basically a self-storage census called the Self-Storage Almanac, and it provides a supply index number. And the supply index number over the past couple of years has fluctuated around 6.5 to 7.5 net rentable square feet per capita. Now, why this is important is because it's correlated to what is the average occupancy of self-storage across the United States. So if we know that the average supply across the United States is a 7 supply index number, and we know that the average occupancy across the United States is 94% occupancy, we could presume that if a market has 7 or less as a supply index number, it's going to experience 94% or higher in occupancy. And then also the inverse. If it has a 7 or higher of a supply index number, it would indicate that it's oversupplied, and we would expect lower than a 94% occupancy rate. Now, a lot of people just look at that and say, oh, it's greater than a 7, I'm out. Or it's lower than a 7, I'm in. But that's an upstream metric. So if we're looking at all the competitors, and we're also looking at the subject facility's performance, we're getting the data, we're getting the information that a supply index number is trying to predict. We have a crystal ball figure that's telling this market's going to have this sort of supply and demand. When we already have the data, as long as you go out there and work for it, that'll tell you what your experience is going to be. So in those markets where they say, oh, the rental rates are declining, they should be able to determine that based on the occupancy figures, as well as doing the competitive analysis of their surrounding facilities. And they would know that in their underwriting, they shouldn't expect to maintain the same rental rates.
Stephen, a few years ago, Flex was exploding. You guys are developers of self-storage. Developing Flex is not much different. Did you ever get into that game?
So we like self-storage to be the kind of heart of a facility, because you brought up earlier of having these ancillary income streams. So a lot of times you'll find self-storage that has other bells and whistles built onto it. It'll have flex space, for instance, in addition to standard self-storage, or it'll have RV units, or it'll have a car wash, laundromat, apartment building, all built onto this same site. We're not particularly big fans of multi-use, but we do see flex space as well as the RV and boat units as kind of a similar variation of self-storage. So as long as it's a minority piece of a self-storage facility, we're into it. So for instance, one of the facilities that we own in Ohio, in Sandusky, Ohio, it does have some of those flex space units where it has the big bay doors, has a pedestrian door next to it, has power. There's utility hookups they can do beyond power if they would like, so that you can run a business, contractor units, whatever you want to call it, out of there. and they perform quite well. We have a lot of people that we know that like the flex units. What we've explored doing with flex units is partnering up and creating that kind of symbiotic geographic clump that I mentioned for, a data center, where I think that a great trinity of properties that have a symbiotic relationship is a self-storage facility, an extended stay hotel, and a flex space facility. Contractors are one of the biggest users of extended stay hotels. By having all three of those together, because self-storage also has overlap with those, I think that is quite a combo.
You've got a lot of ambition, man. I love the out of the box thinking. Stephen, how can the best ever listeners reach out to you?
So you can go to our website, which is SSSE.com. And there's a number of different ways to get involved. But my personal email address is Steven, STEVEN, @SSSE.com.
Thanks for joining us today.
Thank you.
Thanks for sharing what's working for you in self-storage and how you're trying to innovate in this space. Thank you for sharing. And best ever listeners, thanks for joining in today. If you enjoyed this episode, make sure you share it. Don't forget to follow and subscribe so you can listen every Wednesday for Invest Beyond multifamily episodes. And of course, have a best ever day.